Backtesting. It's one of the most useful tools in our financial researching toolbelt. Through it, we can learn more about market history and trends, which can be very beneficial when trying to keep our emotions in check during turbulent market periods. And we can also test any number of unique investing strategies we come up with to see whether or not they would be likely to work for us in the real world. However, just like any tool, backtesting has the potential to be misused, and in doing so, we can often produce results that are at the very least misleading, and at the worst, wildly inaccurate. If we're not careful, this can lead to us making investment decisions that are far from ideal for our financial futures, and end up getting ourselves stuck in quite the financial quagmire, as you'll see with some of the examples in this video. With that in mind, today I'm going to be talking about sources of misleading backtest results, as well as discussing what we probably should be using backtesting for. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to hear more from me and get access to some exclusive perks, all while supporting the creation of these videos, you can become a channel member by clicking on the join button below this video. Before we get into the sources of misleading backtests, it's probably helpful to quickly go over what backtesting is. In its simplest form, backtesting is simply the act of looking back at historical data to determine whether or not an investing strategy would have been successful. So say that I wanted to compare two simple strategies against each other to determine which one would best fit my needs and goals. The first strategy is just simply stashing all of my cash into an S&P 500 index fund and letting it ride. My alternate strategy would be splitting my money equally between an S&P 500 index fund and bonds in the form of a total bond market index fund, with annual rebalancing to ensure that my portfolio doesn't eventually become 90% stocks, or vice versa. How would I actually go about figuring out which strategy I would be most comfortable with? The answer, or at least one of the answers, is to look back at the historical data to see what an investor's journey for each of these approaches would have been like at various points in time, and under various economic environments. I can then take those experiences and use that information to make a more well-informed choice as to where to put my money. Maybe after looking at the data, I'd decide that having my portfolio suddenly drop by 50% or more is just too much risk for me, either because I know myself well enough that I could see myself panicking in those kind of moments and selling my shares, or simply due to something like a lack of job security. In that case, it would be pretty clear that I should probably avoid putting all of my money into the stock market. Or maybe I'd look at things and think, you know what, I have a good job, I'm in good health, I've got cash set aside for emergencies, and on top of that, my budget is in a place where I'm regularly saving a lot of money. I think I'd be willing to deal with a little extra volatility and risk in the hopes of achieving higher long-term returns, which, according to the historical data, is what stocks tend to provide relative to bonds more often than not. In that case, a heavier stock allocation may well be the right move. Either way, that's what backtesting is, and generally speaking, that's probably what we, as regular investors, should be using backtesting for. It's there to test fundamentally sound investing strategies in order to figure out what approach best fits our personality, risk tolerance, situation, and goals. Unfortunately, despite our best intentions, it's surprisingly easy to fall into one of several potential traps when backtesting historical data, which can lead us to making decisions that we later regret. So let's get into the sources for misleading backtests. The first source of misleading backtests is cherry-picking the data. This can come in many forms and isn't always something that we do intentionally or even knowingly, but some of the most common ones are cherry-picking specific time periods and cherry-picking specific assets. We can cherry-pick specific time periods either because we don't have access to very much historical data, so we just use what's available to us, or because we're trying to focus on a specific economic environment that we believe relates to the present or near future environment that we'll be investing in. So say if we wanted to backtest a few new mutual funds or ETFs that have only been around for a few years, it's totally possible that the entire historical dataset falls in the middle of a bullish economic era, such as the 2010s. That can lead to the returns of the investment looking really, really good, especially when comparing it to other investments that have data covering both good and bad economic periods. However, it can also be misleading, because it's entirely possible that the investment has been buoyed by the economic backdrop in which it has existed. A rising tide lifts all ships, after all. With that being said, what can we do in this sort of situation? If the historical data for the investment simply doesn't exist, how can we better backtest it? Well, there isn't really an easy or perfect answer in this kind of situation, but it can be helpful to look at other companies in the same industry and in the same markets to see how they typically perform relative to their own recent data during previous recessions. Again, that's not a perfect one-to-one comparison by any means, because we're looking at different companies with different management teams in place, and no two recessions are exactly the same. But it is at least a step in the right direction compared to just outright ignoring the lack of recession-era data for our potential investment in our decision-making process. Because comparing returns during economic good times to returns in economic bad times can easily lead us into making decisions we later regret. On the other hand, it's also possible to cherry-pick the data knowingly. For instance, this can happen if you're trying to compare past economic environments that are similar to the ones you anticipate taking shape in the present, such as looking at how stocks, or a specific segment of the stock market, has performed in previous inflationary environments when you anticipate high levels of inflation in the present or near future, like what we've been experiencing this past year or so. This is a fairly common thing to do when backtesting, and it's not without good reason. In fact, it can be very helpful in setting up expectations and allowing you to get yourself emotionally prepared for the range of likely possibilities of an investment's performance during turbulent times. It's just that if you end up being wrong in your assessment about the current and near future economic environment that ends up taking shape, and you use that erroneous information to make trading decisions, you can easily be led astray by the results of the comparative backtest. Again, no two economic environments are going to be exactly the same. Contrary to the popular saying, history doesn't really repeat itself, even if it does often rhyme. So unless you're an active trader, and if you are, look for information beyond just the backtest, backtesting in this way is probably best used to give yourself an idea of what is and is not normal during different economic environments, as opposed to making trading decisions based strictly off of how one previous economic environment impacted one investment. Beyond cherry-picking time periods, we can also cherry-pick individual assets or investments. This type of cherry-picking usually takes one of a few forms: either survivorship bias, look-ahead bias, or data dredging. Survivorship bias, to use the dictionary definition, is the logical error when we're concentrating on the things that made it past some selection process and overlooking the things that didn't, typically because of their lack of visibility. In plain English, what this means for backtesting our investments is that we need to be very careful when choosing our historical datasets to ensure that we're not unknowingly leaving out companies that eventually went bankrupt and were delisted from the stock markets. Because whether we're trading on an algorithm or not, those companies did exist at one time, and many may very well have fit our criteria to buy at that time. Therefore, their returns, even if we would have eventually sold them before they went to zero, would have impacted our real-world investing performance. If we don't account for that when we do our backtests, the results are going to look a lot more rosy on the spreadsheet than they will in reality. Look-ahead bias comes into play when data that was not readily available at the time is used in our simulations. For instance, during the 1990s, one of the most common investments to use if you were going to commit look-ahead bias were tech stocks, because obviously in those days, tech stocks were generating returns like crazy, whether or not they were actually profitable, viable businesses. So if you were trying to build a model to beat the market, it's very tempting to decide to pick up some of those tech stocks during the 1990s, which is okay if the rules of your trading algorithm would have led you to picking up those tech stocks anyway. Then you're not really committing look-ahead bias because you're not acting as if you had knowledge of where tech stocks would go by 1999 when you're an investor in 1993. But if you are tweaking things to pick up some of those stocks because you knew they ended up doing well, then you're probably falling into that trap and should rejigger your model accordingly to be more accurate and reliable. Data dredging, sometimes also known as data fishing or p-hacking in certain circles, involves testing a wide variety of trading strategies on a singular set of data until you arrive at a result you're satisfied with. And with tens of thousands of investments available to us at any given time, we're almost guaranteed to find at least one that meets our criteria at any given point. The problem that this potential trap brings up when it comes to investing is that we don't know for sure whether the investment we ended up finding that worked well on our dataset worked well because it was actually a good investment to hold in that environment, or simply because it got lucky. For example, was gold actually a good asset to hold during stagflationary periods? If we look at its performance during the early 1970s, the answer would seem to be very clearly yes. Gold was doing amazing in the early 70s, even earning triple-digit returns in some years. However, was that because it was actually a good asset to hold in that type of environment? Or were there other factors at play that led to it being so wildly successful? Perhaps it had something to do with the fact that gold's value had been held artificially stagnant for so many years prior to the 1970s, and that allowed it to appreciate very rapidly when it was suddenly unanchored from the dollar. It's difficult to know for sure unless we dig a bit deeper. To get an answer to that question, we would need to test the strategy on a relevant data set and then test it again on a different out-of-sample data set to see if the results appear similar. If they are, okay, then we're more likely working with a viable strategy, as opposed to a strategy that just happened to succeed in one time period due to sheer dumb luck. The second source of misleading backtests is overfitting the data. When you're developing an investing strategy that you want to backtest, you need to come up with certain rules that your strategy will operate under, even if that rule is just buy and hold. Maybe you have a rule where anytime the 50-day simple moving average rises above the 200-day simple moving average, you'll buy, and then you'll sell in the inverse scenario. That's a fairly simple strategy, but eventually you may ask yourself, why stop there? You can get so much more sophisticated if you add in a bunch of other parameters and rules to your strategy. And if you do it right, you can achieve astonishingly high returns. There's actually a hilarious Reddit post that illustrates this way better than I ever could, so I'll leave a link to it in the description below. But basically what this can lead to is something called overfitting the data, or curve overfitting in some circles. Basically, what overfitting the data means is that you're tweaking or adding to your rule set or algorithm so that it becomes so over-optimized for the specific environment and time period that you're testing it on that your model no longer holds up well during other environments or time periods. In other words, your model becomes less robust due to being over-optimized for one specific scenario. So this chart with arrows indicating when the trades were made is an example of a well-fit dataset. It'll probably hold up reasonably similarly in a variety of economic environments and time periods. And this chart is clearly overfit and optimized to get the most possible return out of the one specific set of data that it was built on. As a result, as impressive as its precision is, it probably wouldn't hold up nearly as well in most other environments in reality. So when you're backtesting investing strategies, be sure not to go overboard with the rules and stick to financially sound parameters. Remember, the goal is not to achieve the highest possible returns on a dataset from 20 years ago. It's to come up with a strategy that you'll be comfortable with and will work well for you both now and in the future. The third, and for today final source of misleading backtests, is that the backtest often doesn't replicate the investor experience very well. There are things that may not be included in the models, like various costs relating to buying and selling investments, or holding certain types of investments like leveraged positions that charge interest, and for that matter, things that may not be considered, like the potential for margin calls during market downturns. But beyond all of those more mechanical things, there's something else that often gets overlooked that is arguably just as important. It's not a problem because the software we're using is flawed, but rather because it's something that the software just can't really do very well for us. When we're looking back through historical datasets that span many months, years, or even decades, it can be difficult to fully appreciate just how much time is being covered there. When we see market crashes, for instance, we can look at the historical data and go, oh yeah, most of them normally recover within a year or two. And that's true. And when we're looking at spreadsheets, that's a pretty easy thing to say. After all, it's only a year or two. Most investors are going to be investing for 20, 30, 40, maybe even 50 years, considering the length of an average working career and retirement. But when you're actually living through it, a year or two can seem like a really long time, especially when money is tight and you're worried about your job and how you're going to put food on the table for your family. All the while you're watching the value of your nest egg tick down day after day after day. In those situations, it can be very hard to not give in to the temptation to make a move and stop the bleeding, so to speak. And that temporal and experiential aspect of it is something that backtesting with a spreadsheet just doesn't translate very well. Similar things could be said for other situations, like a trend trader having to sit on their hands during a market that's range-bound, or in other words, just bouncing up and down from day to day without forming much of a consistent trend for an extended period of time. It takes a lot of discipline to sit on your hands like that, and it's something that backtesting tools just can't really translate very well for us. So it's important to keep those things in mind when digging through the data and making our decisions, because a backtest that generates excellent long-term returns may not really be worth all that much to us if we're unable to ride the roller coaster that those returns are attached to. So those are some ways that backtests can be misleading. Like I said at the start of the video, backtesting is a very useful tool to have in our financial tool belt. But we've got to be aware that just like with any other tool, there's a right way to use it and a wrong way to use it. If we keep these potential pitfalls in mind when digging through historical data, then we're much more likely to arrive at a decision that we'll be happy with today, tomorrow, and beyond. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.